Hi everyone, it's Matt Lockaby. I'm the managing partner at Lockaby PLLC here in Lexington, Kentucky, and we are back today with our fourth video in our M&A series on the 5 steps in the M&A process. If you've missed the video on the first 3 steps, the formulating, locating, and evaluating steps, check them out at the link below. So today we're talking about the 4th step, the negotiating phase. And what we're going to look at are the terms and conditions that are typically contained within the purchase agreements for these types of transactions. Could be an asset purchase agreement, a stock or equity purchase agreement, could be a merger agreement, or some other type of definitive agreement for the transaction. So let's take one of the more common purchase agreements, an asset transaction in which assets are being purchased by an acquirer from a seller. There are a variety of different sections that are common to asset purchase agreements, and let's just run through them and give you an overview of what the purchase agreement looks like and where there's room for negotiation within each section. The first section in any purchase agreement will outline what's being purchased and, just as importantly, what's not being purchased. And with respect to asset purchase agreements, what liabilities are being assumed, if any, and of course, what liabilities are not being assumed. This section will also outline the purchase price for what is being purchased and how that purchase price is going to be paid, or how that consideration is going to be paid to the seller. Now, obviously, there's cash at closing, whether it's from the seller's own treasury or from bank financing, but there can also be earnouts or payments that are contingent upon certain metrics or performance metrics in the future. There's also seller financing or a seller's note. So there are a variety of different ways that the purchase price can actually be paid to a seller. Another common way of paying a seller is through a rollover of equity. And these are common in certain types of deals, but it's essentially a way for a seller to take some of the proceeds from the sale and roll it over into the equity or the stock in the new company or the acquiring company. Next, a typical asset purchase agreement is going to set forth all of the representations and warranties that each of the parties are making to each other. Now, these are things, statements that the parties are saying are true or not true, as the case may be, that relate to the conduct of the business and also that relate to the parties themselves. And what I mean by that is there are certain reps and warranties, we consider them or call them fundamental reps and warranties, that the parties have the right and the power and the authority to consummate the transaction. Otherwise, for sellers, there's going to be a variety of reps and warranties about the business. Everything related to taxes, to insurance, employee benefit plans, to employees themselves, to a variety of operational matters that are true or, as the case may be, not true about the business on which the buyer is relying in proceeding with the transaction. While there are a lot of reps and warranties that are common in every deal, there are also at times just deal-specific reps and warranties, things that might be necessary for one deal but not for another. Here we think about things like environmental hazards and things of that sort that may be true in a deal involving a manufacturing facility, but may not be true for certain types of professional services, or true is perhaps the wrong word, may not be relevant for that type of transaction. Next up is a section on covenants, and covenants are just promises that the parties make to each other about things that they're going to do or things that they're not going to do, either before and or after closing. For a seller, this would obviously include things like a non-solicitation or non-competition restriction, and it could also mean the type of transition services the seller is going to provide after closing to help with that transition or that integration of the two entities. For a buyer, a common covenant might be the promises they're making with respect to the seller's workforce and ensuring that continued employment for some or all of those individuals. Next is a section on indemnification. This is essentially the section where parties agree to pay or to cover certain types of losses and damages and expenses that may arise in certain situations. More than anything, this indemnification provision is a risk allocation tool that ensures the parties are allocating risk between themselves appropriately based on a variety of information that they've uncovered during due diligence or otherwise as part of the deal itself. Now, this indemnification provision is an essential component and is a really really important component of every purchase agreement or every definitive agreement. Like I said, it is going to allocate risk between the parties, and there's going to be procedures for requesting indemnification. There might even be related holdbacks, which are just specific amounts or percentages of the purchase price that are held back and then finally paid to the seller at a particular date and time, assuming that those amounts aren't needed to cover anything for indemnification. Finally, we have a miscellaneous section. Now, it will include things like definitions of key terms that are used throughout the agreement, but it's also going to include a variety of boilerplate and legalese. But be careful, just because it's boilerplate doesn't mean it's not important. Quite the opposite, actually. It's boilerplate because it is important. So these are things that tend to read a little bit drier, tend to be things that people will skip over, but please pay careful attention to these provisions in this last section, because it is vital and it is critical for a variety of reasons in every deal. Look, what's important to remember in this negotiating phase is that every deal is different. Every buyer and every seller have different interests. Sure, there's going to be non-negotiables for each party in every deal. And there's also going to be provisions that the parties just don't care about or isn't important to them. So the trick is here, sometimes you just got to get creative. There are an infinite number of ways to structure, to negotiate a deal, to reach compromises. Don't get your heels dug in. Keep that momentum moving. Look for creative ways. Look for different levers to get what you need, to get what you want. And we have found over the years that we can always find a reasonable compromise that allocates risk appropriately, that gets parties most of what they want, and most often than not, most of what they need out of every deal. And the trick is be open-minded and to really know what your interests and needs are and working cooperatively toward a final deal structure. For first-time buyers and sellers, don't do this alone. Consult with an experienced legal counsel who can guide you through this process. If you have liked the video, if you found this content valuable, like this video, subscribe, and we'll see you next time.